Imagine this. In October 2025, a quiet tremor shook the foundations of the global economy. It was not an invasion or a political scandal. It was a single line on a ledger. China's holdings of U.S. debt crashed to just $688 billion, the lowest level in over 15 years. They sold while Treasury yields were spiking past 5.5%, a move that guaranteed they were locking in staggering losses. While the media debated the stock market, this was a financial shot across the bow. This single transaction has a direct line to your mortgage rate and the future value of your retirement account. The official story is that this is simple economic repositioning. But the spreadsheets tell a different tale. Why would a nation willingly incinerate billions of dollars? The answer reveals a tectonic shift in global power, and it is not what you think. To understand this financial earthquake, you have to rewind the clock. Go back to a time when Made in China was a new label appearing on everything. For decades, a simple, unspoken deal powered the global economy. China became the world's factory, pumping out mountains of cheap goods. And America? America became the world's consumer, happily buying those goods, often with borrowed money. This arrangement created a tidal wave of U.S. dollars flooding into Beijing's coffers. But that presented a unique problem. What do you do with hundreds of billions in foreign cash every single year? You can't just convert it all to your own currency without causing chaos. You need a parking lot. A safe, stable, massive parking lot for your wealth. For decades, there was only one option big enough: U.S. Treasury bonds. The debt of your biggest customer. This created a strange, symbiotic relationship. I call it the Dragon's Hoard. China sat on a growing mountain of American IOUs in the U.S. Got the cheap financing it needed to keep the spending going. It was a perfect, self-reinforcing loop. More factories, more exports, more dollars, more debt. This cycle reached its absolute peak in 2013, when China's holdings of U.S. debt swelled to an astronomical $1.31 trillion. For a moment, it seemed like the arrangement was unbreakable. But no marriage of convenience lasts forever. Cracks began to appear. Geopolitical tensions rose. Trade wars flared. Slowly, quietly, without any major headlines, Beijing began to lighten its load. Not a flood, just a trickle. Year after year, that mountain of debt began to shrink. What was once a symbol of global partnership started to look more like a strategic liability. The Dragon's Hoard was supposed to be the safest asset on Earth. Now that slow, quiet drawdown has turned into a fire sale. The decades-long arrangement is not just ending, it's being deliberately dismantled. But that brings us to the terrifying trillion-dollar question. Why now? And why are they willing to lose a fortune just to get out the door? This isn't just a headline for Wall Street traders. It's a direct signal about your future. Your mortgage, your car loan, your retirement savings. They are all tied to the value of a dollar that one of its biggest backers is now abandoning. Think of it this way. For 9 consecutive months, China has been a net seller of U.S. debt. This isn't a correction. It's a strategic retreat. Every bond they sell puts upward pressure on interest rates. That makes your credit card balance more expensive. It pushes the dream of a new home further out of reach. We can call this the sovereign squeeze, a foreign power's decision that directly tightens your personal budget. Meanwhile, gold is pushing past $2,700 an ounce. That's not a bet on a commodity. It's a vote of no confidence in the very system that holds your life savings. This wasn't a sudden betrayal. It was a slow, calculated divorce. So how did we get here? How did the world's 2 largest economies become locked in a financial embrace that is now threatening to tear everything down? To see the endgame, you have to understand the opening move. At its peak, China held over $1.3 trillion in U.S. government debt. Think about that number. It was the financial bedrock of the 21st century. This wasn't an accident. It was a system, a perfectly balanced machine, some called the dollar recycle loop. It worked like this. China's factories built your phones and your furniture. You paid in dollars. The People's Bank of China, swimming in a sea of American currency, then used those same dollars to buy U.S. Treasury bonds. Why? It kept their own currency stable, making their exports cheap. For America, it meant a constant, reliable buyer for its ever-growing debt, keeping your borrowing costs low. A perfect symbiosis. The factory of the world financing the consumer of the world. For 30 years, this engine roared. But engines wear out. Slowly at first, then all at once, the gears began to grind. China became a net seller. For 9 consecutive months, the flow of money reversed, a quiet but persistent drain. This wasn't just rebalancing a portfolio. This was dismantling the machine, piece by piece. The public numbers showed a gradual decline. But the real story, the reason for taking a massive loss, wasn't on the balance sheet. It was hidden inside a completely different strategy, a financial failsafe designed for a world on the brink. So how does a country lose a fortune on the safest asset on Earth? It's a question that seems to break the rules of finance. You buy a government bond. You hold it, you get paid. Simple. But China isn't just holding. They are selling. And in today's market, selling is a brutal, expensive game. This isn't a mistake. It's a calculated move, powered by a mechanism hidden in plain sight. I call it the yield seesaw. Imagine you bought a front-row concert ticket a year ago for $1,000. The band was the biggest thing in the world. But today, their new album flopped. The hype is gone. The venue is now selling front-row seats for $500. If you need to sell your ticket, what is it worth? It's not worth what you paid. It's worth what someone else is willing to pay today. You'd have to sell your $1,000 ticket for $500, taking a massive loss. That is exactly what is happening to China's U.S. debt. Here's how the seesaw works. Step 1. Years ago, China bought U.S. Treasury bonds when interest rates were near zero. Think of this as buying the hot concert ticket. They locked in a low but stable return for decades. Step 2. The U.S. Federal Reserve began its historic campaign of quantitative tightening. It started pulling money out of the economy, shrinking its balance sheet down to $8.1 trillion, its lowest point since July 2021. This forced interest rates higher across the board. Step 3. These new, higher rates mean the U.S. is now selling new bonds with much better payouts. The concert venue is selling cheaper, better tickets. Why would anyone buy China's old, low-yield bond at full price? They wouldn't. Step 4. To unload these older, less attractive bonds, China has to slash the price. They have to sell them at a discount. Every single sale locks in a loss. For 9 consecutive months, they have been a net seller. This isn't a trickle. It's a sustained fire sale. The principle is simple, but the scale is almost unimaginable. Selling a few billion at a loss is one thing. But when you are systematically dumping a portfolio once worth over $1 trillion, the financial bleeding is catastrophic. So let's do the math. Let's calculate the real price of this exit. This financial storm needed a first victim. Not a bank, not a hedge fund. The first to fall was something far more important, something built to last forever. Meet the Illinois Municipal Retirement Fund. For 70 years, it was a fortress of financial security, holding the life savings of over 400,000 public workers, firefighters, librarians, school bus drivers. Its portfolio was a monument to caution, anchored by billions in long-term U.S. Treasury bonds, the safest investment on the planet, or so everyone thought. The trouble started in the spring of 2025. As we now know, China had been a net seller of U.S. debt for 9 consecutive months, a quiet, steady drip of pressure on the market. Then, in April, the drip became a flood. Long-term Treasury yields spiked with a speed that panicked the oldest hands on Wall Street. For the Illinois Fund, this was a catastrophe. They were caught in what analysts now call the safety trap. The very bonds they bought for stability were now boat anchors, dragging their entire portfolio underwater. Why? Because when new bonds are suddenly paying much higher interest, your old, low-interest bonds become instantly worthless by comparison. The fund's assets, the money promised to its retirees, evaporated on paper, almost overnight. Suddenly, a retired firefighter in Peoria, a man who ran into burning buildings for 30 years, was reading headlines about his pension being underfunded by 20%. His monthly check, the one he built his entire life around, was no longer a guarantee. It was a question mark. This wasn't a Wall Street game. This was the brutal human cost of a financial system being rewired in real time. The fund's managers had made the safest bet in the world, and they were wiped out by a force they never saw coming, an economic shockwave that began its journey halfway around the world, in Beijing. The panic in Illinois was a tremor, a warning sign of the earthquake to come. But this was just the beginning. To understand how China lost a fortune, you have to unlearn everything you think you know about safe investments. We're told government bonds are a locked box. You put your money in, you get it back with interest. Guaranteed. But this is a dangerous oversimplification. The truth is, A bond isn't a savings account. It's a product. And just like any product, its price can crash. Here's how it works. Imagine you buy a special 10-year ticket to a concert series. You pay $1,000. This ticket guarantees you a seat and pays you $20 a year. A simple, reliable deal. This is China, years ago, buying a U.S. Treasury bond when interest rates were low. Now, a year later, the concert promoter gets desperate for cash. They start selling new 10-year tickets. But these new tickets pay out $50 a year. Suddenly, your $20 a year ticket looks pathetic. Who would buy your old ticket for $1,000 when they can get a new one that pays more than double? No one. If you need to sell your ticket right now, you have a problem. The only way to make it attractive is to slash the price. Maybe you sell your $1,000 ticket for $800. The new buyer still only gets $20 a year, but because they paid less, their return on investment is much higher. They're happy. But you just lost $200. This is exactly what happened to the People's Bank of China. They were holding hundreds of billions in U.S. bonds. Then the Federal Reserve began its aggressive campaign of quantitative tightening, shrinking its balance sheet by over $864 billion from its peak. This sent new interest rates soaring. This is the great secret of the bond market, the part most people never see. I call it the value inversion. The price of an old bond moves in the opposite direction of new interest rates. When rates go up, the value of old, low-rate bonds goes down. China wasn't just a seller. For 9 consecutive months, they were a net seller, offloading billions. In a single November, they dumped over $5 billion worth. They were selling their old, cheap concert tickets into a market flooded with better offers. Most people miss this because they think holding a bond to maturity means you can't lose money. And that's technically true. If you wait 10 years, you get your $1,000 back. But a country like China can't always afford to wait. They needed liquidity. They needed to exit. And exiting meant selling at the current, brutal market price. So what does that loss actually look like on a spreadsheet? How do you calculate the damage when you're dealing with a portfolio that could fund entire nations? The math is unforgiving. And it all comes down to one number. If the Illinois pension fund was a silent tremor, the next break was a gunshot in a library. Loud, sudden, and impossible to ignore. The pattern wasn't just repeating, it was accelerating. This time, the victim wasn't a spreadsheet in the American Midwest. It was an entire nation's industrial heart. Thousands of miles away, deep in Venezuela, the silver mines went dark. This wasn't a labor dispute or a geological problem. It was a full-blown financial seizure. The intricate plumbing that moves U.S. dollars around the globe had frozen solid, and countries living on the financial edge were the first to go cold. It's a pattern I call the sovereign default domino. When the central banks of the world apply pressure, the weakest sovereign states don't just bend. They shatter into 1,000 pieces, creating a crisis for everyone else. What caused the seizure? The exact same force that buckled a pension fund was now crushing a nation. The Federal Reserve was pulling money out of the global economy at a historic pace. Think of it, over $864 billion vanished from its peak balance sheet. This creates a powerful vacuum, sucking dollars out of international markets. If your entire economy runs on selling commodities priced in those same dollars, you suddenly can't pay your bills. You can't import food. The lights go out. The lessons from decades of financial history were simply ignored. Did anyone truly believe this time would be different? The world watched this exact story play out in the 90s. But the scale now is terrifyingly new. The interconnectedness is absolute. And Beijing was watching. They saw the first domino teeter. They didn't wait for it to fall. The data is undeniable. For 9 consecutive months, China was a net seller of U.S. debt. Month after month, billions flowed out. By early 2026, their holdings would crater even further, hitting $682 billion. This wasn't portfolio rebalancing. This was a fire drill. They were evacuating before the alarms even started ringing for the rest of us. The collapse of a national economy isn't an abstract event. It sends shockwaves that travel instantly across the planet, hitting the price of everything from your phone to your food. And here's where it gets personal. Let's do the math the media won't show you. It's a mechanism I call the coupon crusher. Imagine you bought a 10-year U.S. government bond for $100,000. It pays you a fixed 1.5% interest. That's $1,500 a year, every year. Safe. Predictable. Boring. But then the world changes. Suddenly, new bonds are being issued, that pay 3 times that rate. Now, ask yourself, who would buy your old 1.5% bond for the full price? Why would they pay you $100,000 for an asset that pays $1,500 a year when they could buy a brand new one that pays $4,500? The answer is nobody. To get rid of your old bond, you have to sell it at a discount, a steep one. The price has to fall until that fixed $1,500 payment looks like a good deal again. Your safe $100,000 asset might now only fetch $70,000 on the open market. You just took a 30% loss on the safest investment on the planet. Now scale that up. China didn't hold one bond. They held a mountain of them. In a single month, November, they dumped over $5.39 billion worth. Imagine taking that 30% haircut on billions. This wasn't a gentle sell-off. It was a fire sale during a hurricane. The Federal Reserve itself had sucked $864 billion of liquidity out of this very market. China wasn't just selling. They were selling into a vacuum. The raw loss is breathtaking. But it isn't the real story. The real story is the willingness to accept that loss. Why would a nation intentionally set a fortune on fire? Because the alternative was even worse. This raises a terrifying question. What are the scenarios where losing billions is the best possible move? Now, every time this story breaks, you hear the same counter-argument, the official explanation, the one designed to keep you calm. They'll tell you this is just portfolio management, a simple rebalancing. They'll argue that China would never weaponize its debt holdings because crashing the dollar would be economic suicide. It would be like setting fire to their own bank vault. It's a logical argument, and on the surface, it makes perfect sense. Why would anyone intentionally destroy their own savings? But that argument mistakes a controlled demolition for a sudden explosion. Rebalancing doesn't look like being a net seller for 9 consecutive months. A simple portfolio shift isn't a constant, one-way flow of capital out the door. Look closer at the monthly numbers. In November alone, China sold another $5.39 billion. This isn't a shuffle. It's a strategic bleed, a slow, deliberate draining of dollar exposure, designed to go unnoticed by the mainstream. And the critics are partially right. Beijing isn't flipping a switch to cause a panic. That would be reckless. Instead, they are quietly building an escape hatch. They are steadily converting those paper dollars into hard assets, a key reason gold prices have soared past $2,700 an ounce. They aren't burning their house down. They are selling it piece by piece before the foundations give way. This isn't about causing a crisis tomorrow. It's about surviving the one they see coming. But even if they were right, so where does this road lead? 2 futures are branching out from this moment, and you are living in one of them. In scenario A, the bleed is slow. A managed retreat. China's holdings continue to shrink, perhaps hitting $682 billion by the end of the year. For you, this feels like a gradual tightening. Your next car loan is a little more expensive. Credit card rates inch higher. The change is so slow, you might not even notice the cause. It's a simmering pot, not a boiling explosion. The most probable path, according to the experts. But then there's scenario B. I call it the sovereign shockwave. This isn't a retreat. It's a financial blitz. China doesn't just sell. It dumps its remaining holdings in a coordinated, rapid-fire sale. The goal isn't to get the best price. The goal is to create chaos. In this future, Treasury yields don't just rise. They launch. The stock market enters a freefall. The flight to safety isn't into dollars, but into physical assets. Gold doesn't just climb. It punches past $2,700 an ounce. The probability? Low, but not zero. It's the financial equivalent of a nuclear option. Of course, the skeptics will tell you this is all just fear-mongering. They'll argue that scenario B is impossible. Why would China detonate a bomb that would inflict just as much damage on its own economy? It would be an act of self-destruction. Now let's pause. Because the smartest people in the room will raise an objection, and they have a point you need to hear. They'll say this isn't a fire sale. They'll argue China is just letting old bonds mature and not reinvesting. It's a quiet, orderly exit, not a panic. They'll correctly point out that countries often hide their holdings in foreign accounts, like those in Belgium, making the true numbers a state secret. And they are not wrong. Tracking this money is like trying to follow a single fish in the ocean. But that argument completely misses the one signal that cuts through all the noise. I call it the persistence metric. It ignores the complex accounting and focuses on one brutal fact, the direction of the trend. the U.S. Treasury's own data reveals the pattern. As of December 2025, China had been a net seller for 9 consecutive months. 9. That isn't portfolio management. That is a policy. Letting a few bonds expire is one thing. Actively selling, month after month, for 3/4 of a year, is a deliberate financial retreat. It's the difference between walking away from a negotiation and slamming the door on your way out. When the pattern is this consistent, you have to stop looking at the spreadsheets and start looking at the strategy. The numbers tell a story of managed decline, yes, but they also scream intent. This brings us past the public statements and the expert denials to what I believe is really going on behind closed doors. So what am I doing with my own money? Before I say another word, the disclaimer is non-negotiable. I am not a financial advisor, and this is not financial advice. This is simply a look inside my personal playbook, for educational purposes only. Frankly, I'm a buyer in this chaos. I am hunting for what I call the contagion discount, the moment when good assets get thrown overboard simply because sellers have run out of choices. My first trigger is a number, not a news report. I'm watching gold. A sustained move above $2,700 an ounce signals to me that the flight from paper assets is accelerating. My second trigger is the Fed's balance sheet. When the pace of their asset reduction, which has already shed over $864 billion from the peak, begins to slow, that's the tell. That's the moment the pressure valve gets released. As for position sizing, my approach is surgical. Small, initial allocations. I am not trying to catch a falling knife with my entire hand, just a fingertip. It's a strategy built for volatility. Because after the margin calls and forced liquidations comes the silence. And in that silence, the smartest money in the world gets to work, laying the foundation for the next great surge. We've followed the money, from the peak of the dollar's dominance to the slow, deliberate exit of its biggest banker. This was never just portfolio management. It's a geopolitical divorce, finalized on a spreadsheet. For 9 consecutive months, the selling has continued. A quiet, relentless pressure building behind the walls of the global financial system. The question is no longer if this system will change, but what it will change into. Because while the headlines focus on treasuries, other assets are moving in the shadows. Gold is already pushing past $2,700 an ounce. But the real story, the one that could trigger the next phase, isn't happening in a bank. It's happening in the silver mines of Venezuela. That's the next domino we'll be watching. The rules of money are being rewritten. The only question is whether you'll read them in time.